If you're saving $500 every month, you probably think you're smart, responsible, securing your future. But the truth is, you're trapped in a game where the illusion of winning is given to you, while in reality, you're slowly losing. And the most dangerous part? You won't even see yourself losing. Imagine this. Every month, you consistently set aside $500. You control your spending, avoid impulse buying, and watch your bank balance grow. Slowly. 500, 1,000, 3,000, 6,000. And inside you, a feeling starts to build. I'm financially responsible. I'm better than others. My future is safe. That's the biggest trap. Comfort plus the illusion of progress equals a dangerous combination because you're only looking at a number, but in reality, you're not seeing value. Now ask yourself a simple question. If you have $6,000, can you buy the same things you could 1 year ago? The answer is no, because the world is constantly changing. Food is getting more expensive, rent is rising, education costs are increasing, healthcare is becoming expensive. And this change doesn't happen suddenly, it happens slowly. So slowly that you don't even notice it. Inflation is not just an economic term, it's a silent system that over time reduces the power of your money. Imagine this. You have a bucket where you pour $500 every month, but there's a small hole at the bottom. You keep pouring, but little by little, it keeps leaking. What's the problem? You can't see the leak, so you think, I'm growing, but in reality, you're just ignoring the leak. The human brain loves three things: certainty, stability, and control. Saving gives you all three. Your balance looks stable, risk feels zero, outcomes are predictable. So your brain tells you, this is safe, keep doing this. But there's one thing your brain doesn't understand. Stability does not equal progress. You can be stable, but not moving forward. And in finance, if you're not growing, you're falling behind. Saving is a linear game. That means every month, 500 plus 500 plus 500 plus 500, a straight line. Simple, predictable, safe. But now look at the real world. Companies grow exponentially. Technology grows exponentially. Wealth grows exponentially. That means the real world is a curve, but your saving is a line. Now think about it. If you're moving in a straight line while the world is accelerating in a curve, what happens? You fall behind, even if you're consistent. Now here's the most dangerous part. The biggest loss in saving is invisible. Example, you didn't invest your $500. What did you lose? Nothing, right? Wrong. You lost future returns, compounding, and time advantage. And this loss is so big you can't even imagine it. In finance, the biggest losses are not what you lose, but what you never allow to grow. That means you didn't lose money, you lost opportunity. And opportunity loss is always invisible. Now here's a dangerous mindset. I'm a saver. It feels safe, but the problem is you limit yourself. You avoid risk, you avoid growth, you avoid uncertainty, and slowly you freeze inside your comfort zone. So now the question isn't whether saving is good or bad. Saving is necessary. But if you're only saving, you're in a system where you will survive, but you will never grow. So the problem isn't saving. The problem is your fear that stops you from investing, and that fear is what keeps you average. Your $500 is not the problem. Your mind is. Because the same $500 makes one person rich and keeps another person average for life. So where's the difference? Not in the investment, but in the psychology behind the decision. Imagine this. You're about to invest. You're ready. You've decided. But the moment you're about to click that button, a voice in your head appears. What if I lose money? What if this goes wrong? What if I make a mistake? And you stop. This isn't random. This is how your brain is wired. The human brain is designed to avoid one thing more than anything else: loss. Science shows that the pain of losing money is 2 to 3 times stronger than the pleasure of gaining the same amount. That means losing $100 hurts far more than gaining $100 feels good. So what happens? You avoid risk, you play safe, you choose saving over investing. Now here's the most dangerous illusion. There are 2 types of loss. First, visible loss. You invest $500 and it drops to $450. You see it, you feel it, it hurts. Second, invisible loss. You save $500, but inflation quietly reduces its value over time. You don't see it, you don't feel it, but it's still happening. Both are losses. The only difference is, one is visible, the other is hidden. And here's the deep truth. Humans don't avoid loss, they avoid feeling loss. That's why visible risks are avoided and invisible risks are ignored. Now let's talk about what scares most people: market volatility. When markets go down, everything turns red. News becomes negative, people panic, and your brain tells you this is dangerous. But elite investors see the same situation differently. They see opportunity. Because volatility is not the same as risk. Volatility is temporary movement, prices going up and down. Risk is permanent loss of capital. If you don't sell and panic, you haven't actually lost. But the moment you react emotionally and exit, that's when the loss becomes real. Now here's a brutal truth. Investing success is not about strategy, it's about behavior. Two people can choose the same investment. One panics, reacts to news, sells early. The other stays calm, thinks long-term, and remains consistent. 10 years later, one is confused, the other is wealthy. The difference is not intelligence, it's behavior. Now think about confidence. Imagine two people again. One only saves, never invests, always plays safe. The other starts small, invests a little, learns from the market. Over time, the investor builds confidence, understands patterns, becomes comfortable with uncertainty. The saver does the opposite. They become more fearful, more hesitant, more stuck. And here's the deep insight. Wealth is not built by money, it is built by confidence under uncertainty. The more uncertainty you can handle, the more you can grow. That's why wealthy people are comfortable when things are uncertain, while average people stay stuck in comfort zones. Now comes the biggest shift: identity. When you start investing, something changes. You're no longer just saving money. You become a decision maker, a risk manager, a long-term thinker. And these traits create future wealth. So now the real problem becomes clear. It's not that you don't have enough money. It's not that opportunities don't exist. The real problem is your mind holding you back. Fear, doubt, hesitation, these are the forces that create the gap between an average life and a wealthy one. So the real question is not whether you can invest or not. The real question is, can you control your mind? Because if you can't, even $500 will never make you rich. Now you know the truth. Saving keeps you safe. Investing helps you grow. But the real question is, how do you use $500 in a way that it stops being just money and starts becoming a machine? Most people ask the wrong questions. They ask, where should I invest? Which stock is the best? How much return will I get? But the top 0.01% think differently. They ask, how do I build a system where money grows automatically? Because a single decision gives a limited result, but a system creates compounding results. Motivation is temporary. One day you feel inspired, the next day you feel distracted. But a system doesn't rely on emotions. It runs automatically. Imagine this. Every month, your income comes in and $500 is automatically invested. You don't think about it, you don't hesitate, but in the background, your wealth keeps growing. This is how real progress is built. Now, let's break down how elite thinkers structure their money. They don't just invest randomly, they assign roles to every dollar. Think of your $500 as being divided into 3 layers. The first layer is safety, around 10 to 20%. This is your emergency fund, your short-term stability. Its purpose is simple, to protect you when things go wrong so you're never forced to sell your investments in panic. This is your shock absorber. The second layer is growth, around 60 to 70%. This is your core engine. This is where your money goes into long-term investments, broad market assets, compounding vehicles, things that grow slowly at first but powerfully over time. This may feel boring in the beginning, but this is where real wealth is built. The third layer is asymmetry, around 10 to 20%. This is optional but powerful. This is where you take calculated high-risk, high-reward bets, new opportunities, emerging trends, ideas that have the potential to multiply. Most of the time, these won't work, but when they do, they create exponential results. And here's the deep insight. Wealthy people don't put money in one place. They give every dollar a job. Some dollars protect, some grow, some multiply. Now let's talk about the most underrated force, automation. The truth is, you are not as disciplined as you think. No one is, but a system can be disciplined. When you automate your investing, you remove decision-making, you remove emotion, you remove delay, and wealth starts building quietly in the background. Now comes time, the real multiplier. If you invest $500 every month for years, it won't look impressive at first. Growth will feel slow, almost invisible, but then something changes. There comes a point where growth starts accelerating, not because you invested more, but because compounding finally becomes visible. And this is where most people fail. They quit before this moment arrives, because compounding is not magic, it is simply time, consistency, and patience. Now comes the real formula. Wealth equals consistency multiplied by time combined with behavior. If you stay consistent, think long-term, and don't panic, even $500 is enough. But if you keep jumping in and out, reacting emotionally, and chasing quick gains, even $5,000 won't help you. And now comes the final shift, the most important one, moving from being a saver to becoming an investor, from being a consumer to becoming an owner. When you invest, you are no longer just holding money, you are owning businesses, participating in the economy, growing with the world. This is the difference between working for money and money working for you. And here's the ultimate truth. You don't need more money, you need a better system. So now you have a choice. You can keep saving $500 and feel safe, or you can invest $500 and slowly build a life where you are no longer dependent on working for money. Because in the end, being rich is not about having more money, it's about having money that works for you.